right in the middle of the meeting, Jimmy Carter, who was then president, fired something like 32 members of his government, 13 members of cabinet, everybody. He just cleaned house right in the middle of this meeting. And everybody ran out of the door because they were all short and gold was going to the moon. And so he turned to his lawyer and he said, "What does it mean?" And his lawyer looked back and he said, "The hearing room has been evacuated. I guess the case from you has been dropped." And so that was it. From then, that was at about $400 an ounce. We ran to $887.50 within the next year, and he managed to get out at the top. And so he named his house in Scarsdale, New York, Carter Acres, with a very famous quote. The man was incredible. Every time he spoke, the dollar fell and gold rallied.
Monaco 64, home of alternative economics and contrarian views. Well, today we have a guest that a lot of you have been waiting for. He's the co-author of A Pocketbook of Gold, a survival manual for monetary mayhem. He's Peter Carlin. Of course, he wrote the book with Jim Sinclair. Welcome to the channel, Peter. It's really great to have you.
Mario, great to see you. How are you?
I'm fine, thank you. Before we tell the viewers about the book, could you speak a little bit about yourself, your background, and how you met Jim? And maybe you could tell the viewers some of the stories about Jim. I like the one about what he named his property on Long Island, or is it Connecticut?
That was one at Scarsdale, New York at the time. But my background is as a foreign currency options market maker, trader. I started very young. I had a seat on the options exchange for FX in America, and I was there for a number of years, and later moved to the United Kingdom, to London, where I worked first on life and with Cargill, and then later on I started again in the OTC markets. In between time, I was writing for the Financial Times and also for Bloomberg. And then I went back to the trading and broking markets in the over-the-counter derivatives for the Brent market, Brent and TI. And then later in the nat gas and electricity markets. And for a period of time, I was also an options market maker on the London International Petroleum Exchange, where we did Brent and gas oil, also coffee, cocoa, sugar at times, a lot of different things. I was working with Mikata Metals, the world's oldest firm in the Western world at the time, and the premier kind of gold outfit, who had been trading gold since I think about 1637, making it one of the oldest corporations, if not the oldest trading corporation in the world. So that's my background. And then along about the time the beginnings, the embryonic form of the global financial crisis started to take shape, I started to get very interested in the gold market because I saw it perking up around early 2007. It was right at that time that I was listening to the radio and I heard that Banque Nationale Paris, BNP, had started to close down some of its funds because of its inability to value what the assets on the book were. And I remember it just shocked me. And I was like, this is going to be a problem. If all of a sudden nobody can get into these funds, and it was only 2 funds at the beginning, I immediately thought something's going to happen. And sure enough, something did happen. That was the first warning shot of the global financial crisis. And my first instinct was, you better buy gold. This is going to be a problem. And so I started looking into the gold market more and more. And I found that there was really nothing of any value on the internet about it. Little, if anything at all. And I, through some research, wound up with a link to jsmindset.com. And that was the beginning. I managed to work through what was going on there. What was interesting about it too was that Jim wasn't really just writing about gold, but for the people who had the time and were curious, he was literally running a graduate school in commodities trading and monetary policy. He was demanding homework from people. He was having you fax in homework for him to grade by hand. He was asking questions. He was telling all the students, the people who were with him, that if you didn't do the work on time and properly, he was going to password the site, and only a certain amount of his students were going to get in. And so I started really putting in an effort. And then he became open to phone calls because, being a trader, he's used to sitting with thousands of flashing lights in front of him and taking call after call after call after call after call, during the trading day. And so we started to talk. And the first few phone calls we had were to do with his site and what he saw as a monumental problem that was about to be exposed in the over-the-counter derivatives markets. This later gets turned into the movies like The Big Short and the general discussions on these things, that it's really about mortgage-backed securities. But in reality, MBS was only one small part of the issue. There was a much bigger issue in the interest rates markets and the bespoke derivative markets, which were all what he would call new, untested, unaccounted for monetary aggregates that are hidden from view, and there's a quadrillion of them, literally $1 quadrillion. And so we started to talk about the impact this was going to have on the markets. And quite honestly, that's still the world that we're living in now, even though the banking system was rescued around 2011, 2012 with the bailouts and whatnot, that we are still working off that OTCD problem, that over-the-counter derivatives problem. As I believe one of your guests, Alex Craner, had pointed out not too long ago, it's not an official documentation, but so far it appears that the OTCD market has already sucked down $23 trillion worth of global capital in an attempt to resolve the unresolvable bilateral credit arrangements that have caused the problem when you use uncleared instruments, which is what the over-the-counter market was. Now, fast forward to today, they've taken a lot of those swaps, options, and other things, and they've put them on exchanges where they clear, but a lot of them still exist out there in the kind of ether, what I like to call the night of the living derivatives world, where they're going to come back and are always periodically coming back for more and more banking problems, more and more liquidity problems. So anyway, that's the background of how we met and what we were first talking about. So we started to talk more and more, and I said to him one day, I said, God, it'd be great, instead of doing this during trading hours, if we could sit down sometime and actually discuss this face to face. And he said, I've got 3 hours layover in Tanzania, Dubai airport on Thursday. And I said, I'll be there. And so we had met there, and then we spent some time together at his house in Connecticut, in New York, and in London as well, which he used to come to occasionally. And so what I wanted to know from Jim when I first met him, of course, like all people in the trading environment, was I was kind of looking for the magic pixie dust. This was a guy who in the 1970 70s bull market was the largest cash trader in the market by far. And as he would say, the futures market is a pimple on the ass of an elephant compared to the cash market. The cash market is where the real action is. And he was literally the largest trader, market maker in the cash market. But he also ran a futures book and a physical book all over the world, in India, in Japan, in Southeast Asia, in Hong Kong. So he had a total global operation. And when we were getting towards the end of that period, 1979 into March 1980, he was long 22,000 lots of gold futures. and 5,000 lots of silver. I mean, if you do the math, tick size is one lot, one tick, $10. You can see that $1 moves were worth millions and millions of dollars on his position. So that's the kind of position the guy was running. So when I finally met him, I was like, great, I want to find out how he does this. I want to know what the secret sauce is. And so I asked him straight out. I said, who had the biggest influence on you as a trader? I mean, the first thing he told me was, I said, well, to what do you credit your great success in the gold market? And he said, well, I just got lucky. I said, Jim, I don't believe that. Nobody gets lucky in trading. You know it, and I know it. And he laughed. I said, let's try a different angle. Who had the biggest influence on you as a trader? And he said to me, well, I am the only son of whom I know to have been the greatest lone wolf trader ever in the history of Wall Street. He never read the Wall Street Journal and he never looked at a chart, but he was a market sensitive and the greatest trader I've ever seen. It was his father, Bertram Seligman. And he was partners with Jess Livermore, the infamous Wall Street legend, who sought him out simply because, sought Jim Sinclair's father out because of how talented he was. So that's the background to that. He was 12 years old and he was a market maker then. At 12 years old, he started in the market. At age 19, he was a market maker in 35 different stocks, and then was the only person who was a general partner of 2 New York Stock Exchange firms, I think at the age of about 25. So he was a Wall Street titan in every sense of the word. He told me a lot of stuff about what he was doing in his positions throughout his history. But at the time we went into the market in the 70s, he was the largest market maker out there. And that was kind of sanctified by the COMEX itself, because in 1979, he was called before the board of COMEX and charged with manipulating the world gold market. Like one person can do it, but he was. And of course, the real point of it is that he was the big long, and everybody else in the market, including the board of COMEX, were the big short, and they were getting killed. So as he called it, the meeting to fry me was had in the boardroom, and all the partners were there, and they were going to destroy this guy, and they were going to get him out of the market, charge him with manipulating the world gold market, and pull his book off of him and get rid of the person who was long, and then they would be able to move the market back down, and the shorts would be rewarded, or at least get some of their money back. And right in the middle of the meeting, Jimmy Carter, who was then president, fired something like 32 members of his government, 13 members of cabinet, everybody. He just cleaned house right in the middle of this meeting. And everybody ran out of the door because they were all short and gold was going to the moon. And so he turned to his lawyer and he said, what does it mean? And his lawyer looked back and he said, the hearing room has been evacuated. I guess the case from you has been dropped. And so that was it. From then, that was at about $400 an ounce. We ran to $887.50 within the next year, and he managed to get out at the top. And so he named his house in Scarsdale, New York, Carter Acres, with a very famous quote. The man was incredible. Every time he spoke, the dollar fell and gold rallied. I named my home Carter Acres after him. And his home was a 47-room mansion in Scarsdale, New York. So that's the Carter Acres story. So we talked a lot about derivatives and how they were untested and unregulated, and how it was going to become a really big problem, because I had worked on a lot of these things myself when I was in the market. For instance, the fact that they were uncleared, unaccounted for, and there was trillions of dollars of these on the books was something I wasn't aware of at the time. But what I was doing was I was putting together deals. And these deals weren't just about, I wasn't doing MBS or interest rate products, but there were all sorts of bespoke derivatives, knock-ins, knockouts, strangles, one-touch, look-backs, bandwidth, weather derivative options, weather derivative structures. For instance, one example is I did one of the first European weather derivative structures between Enron and a very, very large insurance company who wanted to trade the instrument. I don't know if they had anything against it or not. I think Enron at the time was more or less the market maker. The insurance company probably had a captive principal that they would back to back on or something. And to do a weather derivative without boring everyone to death is quite a strange structure for options traders, because it does have strike prices and duration theta and a price out that's guaranteed. But you have to invert the scale compared to what a normal option is. So up is down. Once you see that up is down, because it's based on temperature, and this was a heating degree, an HDD call at Heathrow, you start to make sense of it again. But the insurance company didn't, and I told them 3-4 times, I said, you have got this priced upside down. You've got this wrong. And they said, no, we haven't. We're done. I said, fine, you're done. You've traded. Give them the counterparty, Enron. Enron starts to laugh. He goes, I got a message for your counterparty. I said, let me have it. He said, do you really think the average temperature at Heathrow next year is going to be -4 degrees Celsius? And they absolutely panicked, and they realized they had got it wrong. But that's indicative of what the OTCD market was like. You were making up different structures all the time, and nobody was going to account for them, and you can't trade out of them like futures. So that's how we started our conversation. That's why we decided that we'd really need to write a book about gold as a kind of handbook for the average person to know what happens when you buy gold, why you should do it, what form it should take, and what you better be aware of. So that was A Pocketbook of Gold, a survival manual for monetary mayhem, which is being released now at apocketbookofgold.com.
Yeah, and Peter, before we look at the pocketbookofgold.com, I remember I started following JS Mindset around 2002, because that was when I bought my first Krugerrands. And I remember Jim writing about when the great financial crisis was brewing, like you said. He was one of the first people to write about credit default swaps, and no one really knew what those were, and he was proven right. So let's get to the book here, and I'm going to share it with the viewers. There's the pocketbookofgold.com. Just one question, Peter. Will you be able to publish it in book form eventually, or because right now it's just a PDF? And it's
no plans to do that. Really, the thing with printing and distribution is kind of a full-time job. This was hand done, the book that you have in your possession, and was kind of made as a keepsake. As you can see, it's extremely well bound. The paper quality is of the highest level. Gold embossed cover. That's why it was so expensive to buy. I think now they're trading for something ridiculous like $350 or something. I don't know. But it was a limited run. We wanted people to have it as a keepsake. Right now, there's no real prospects of us making another run, certainly of that. And we didn't really want to do a paper book run of it. But the demand for it has kind of always been there, lurking in the background. But now, once we went through 3,000, I said, look, we have to reissue this. We have to reissue this. Too many people need it. And considering how, PDFs are now regularly traded online, because back when we released the book the last time, 2010, it really wasn't. So I wrote a new foreword. We tidied up some of the copy and just spelling errors, punctuation. And it's pretty much as is, because it is made to be. It's also made to be a reference book, as well, without being boring. So it kind of tries to marry the two angles of a reference book and a readable narrative at the same time. So because a lot of people are going to come into the gold market soon, and nobody's going to know what to do, and there's going to be confusion reigning everywhere. I'm sure you had it probably, unless you were a gold trader when you first came into the market. I had been in commodities for 25 years, and even I was like, I don't know if I want to buy an ETF. An ETF doesn't sound like the greatest thing in the world to buy. And I was kind of like, well, what are these differences between coins? There seem to be 4 or 5 different types. Which one should you get? And then, why people settle on Krugerrands, which are good because they don't get damaged as easy
Yeah.
as the Maple Leafs and the Philharmonics. So
I learned as well because here in the UK, coins of the realm are capital gains tax free. So I didn't know that in '02. It was June '02 when I bought my first Krugerrands. But eventually I learned that and I was able to swap my Krugerrands for sovereigns. So
right,
you're always learning something new.
right,
But yeah,
absolutely.
Peter, today, the day we're speaking today, gold is actually traded above 3,800. Actually, the right now it's at 3,821 in the spot
Yeah.
market, and silver traded above 47. So my question to you is, are we close to the monetary mayhem? I mean, it's 15 years. I'm not like saying, and I'm not like criticizing you because these things don't happen overnight.
Right.
But my feeling is that things are getting quite interesting now.
Yeah. Well, we've been in the monetary mayhem really since about the great financial crisis, 2008, 2009. But if you don't mind me backing up, that's not what got gold off the floor. And here's another thing that Jim was involved in. When you ask him what happened around 2002, 2003 that made you get back in the market, you've got this great cash trader for gold who dropped the market at its height in March 1980 and walked away for 22
Yeah,
years.
I think he told us as well on JS Mindset that he bought treasuries at double digit yields.
Yeah.
So he did the great trade in gold and in treasuries. Anyway, sorry.
No. When I asked him that, he said, well, at 250, you're basically at the cost of production. And he also, because he's extremely rigorous in his research, said within the tiny gold market at the time of the people in the mining industry, there were $38 billion of outstanding derivatives, and you knew they were all miners being short. And so the miners had financed themselves by selling swaps and options at higher strikes into the major banks, JP Morgan, Goldman, people like that. And once they ran out of ammo, they squeezed the market and they forced them to cover. And so when the miners had to cover, because, I mean, think about it, producers are shorting the market. That doesn't make a lot of sense, does it? But they were, because as I asked him, I said, well, why would they do that? He said, because it gave them a hamburger today.
Yeah.
But as he said, it turned into crack cocaine finance. Once they tasted what they thought was free money, they couldn't stop. So then they got forced, we got to 400 on the back of that. And then they were forced to cover, and that got us to about 600. So the monetary mayhem has been around since the great financial crisis. We went up strongly into the banking resolution of 2011, and then we pulled back for about 4 years, 4.5 years. Pretty big pullback. I think about, was it 1920 to about 1048. Quite honestly, Jim said at the time, and he was still in jail, Martin Armstrong was the person who tipped the market on that. He said in 2011, you're going to get a pause for a few years. So good on Marty for pointing that out. So what happened was the banking system got bailed out and gold went back down. But the problem wasn't solved. So it came back, which is why I call it Night of the Living Derivatives. So they got up some breathing room, but the problem didn't get rectified. And so then we've been in this ever since. And right now we're starting to get into the meat of the situation. And part of the problem is that this is now coalescing with a drive towards war. And they are kind of interrelated. They are interrelated. War, debt failure, sovereign defaults, and the rise of gold go hand in hand, as they did before World War I, as they did during the Suez Crisis in '56, where Eisenhower and his Treasury Secretary Humphrey more or less threatened Britain and France to pull out of the Sinai, pull out, and Israel to pull out of the attack on Gabel Nasser's troops, because they were already winding down their reserves to prosecute this war. Sounds familiar? Now we have the IMF getting ready to come into Britain and France again. And this is kind of where the IMF, which is essentially run by Washington, found its wings. They didn't know where they were going to get the money from. And the IMF, which had done very little between its inception at Bretton Woods and its institutionalization in 45, 46, for the next 10 years, it was the Suez Crisis that brought the IMF to life, where it had been doing very little since, except collecting dues payments and a bit of gold. So we had that situation, and then we had the 67 situation also, where the next Arab-Israeli war took place, and we had a devaluation of sterling from 280 to 240. And then the 73 Arab-Israeli war, which then put Britain into another financial crisis. The government fell. I think it's Harold Wilson's government fell, or was it Macmillan? Anyway, Macmillan was after the war. So, that also became a crisis. And excuse me if I've got the prime ministers wrong. Someone's gonna have my head on that one. But we got to that position, and as you can see, all of these things kind of work together. You have these situations where these Middle Eastern wars take place, and then all of a sudden, they coalesce into an Anglo-French-American foray into war, either against Egypt, Lebanon, Egypt/Palestine, and and from there away we go. And so now we're in this position, which has been exacerbated quite a bit, not only because we have that conflict going on, but we have the Ukraine conflict going on. And the Ukraine conflict, thank you.
I think it was Edward Heath.
Heath.
Edward Heath, yeah.
Okay.
And also in '67, it was Harold Wilson, and he famously said after the devaluation that the pound in your pocket will still be the same.
Yeah, it's the same because the price of groceries went up like 20%. So yeah, it wasn't really. It might look the same, but it won't feel the same. So now we're in the same situation, where we have this Ukrainian situation, which has really multiplied this beyond anybody's wildest imagination. I mean, you're looking at a commitment by the EU of $210 billion there. They have various forms of assistance, $92 billion in financial and budgetary support. Military assistance is $65 billion. So they've made that that's about 100, whatever it is. There's about 186 outstanding there, and they're pledging more. And they are in up to the eyeballs on this. And these are all 65% of these are grants, and 35% of them are in highly concessional loans, which means they're going to default. They're already defaulting, and you're never going to see the money back. So 100% of it's gone. So the EU is eating, as it is today, $220 billion on the back of Ukraine alone. That's part of the reason gold's going up. These guys are getting ready to call on the IMF, and quite honestly, with the example I gave you from Suez, if Trump wanted to end the war, he would do what Eisenhower did in '56. He would simply tell the IMF, "You're not bailing these guys out," and France and Britain would shut down this war effort tomorrow. They would have no choice.
The IMF, I think the U.S. Treasury has 18% of the shareholding, and you have to have above 17% to have a veto. So in effect, it's the foreign
Yeah.
for an arm of the U.S. Treasury.
Yeah. And that was fought over after World War II. What used to, and not to take away anybody's ire for the Federal Reserve, but the Federal Reserve used to be in charge of all of that. And when World War II ended, a lot of their power was taken away and given back to Treasury. And the IMF, and Keynes specifically, was apoplectic with rage that they decided to locate it in Washington, D.C., strange for a statist, instead of London, or at least New York, because you could see what was going to happen. The U.S. government now was going to become, through the IMF, the clearinghouse for multilateral trade. And that's in effect what it did become, even though it took 10 years or so to get there. It had to wait for convertibility to take full effect in 58. But so it became the person who was basically overseeing the multilateral disaggregate parts of balance of payments structures, and again, buffeting people's reserves so that balance of payments could be rectified. So that became Washington, and not the banks. So the IMF took a big role there. And of course, the IMF's big role, which nobody wants to really talk about too much, which was to manage the decline of the British Empire after the war, to manage it so it wouldn't get out of control, which is what they did, because the IMF, except for a bit of France and a few other small things, was essentially run for the British for the first 20 years.
I see.
25 years or so, you know.
Yeah.
And there was a running joke in the IMF too, that the beauty of their offices and the lush lifestyle that the IMF officers had was due to the fact that Britain was constantly paying off their debts to the IMF. and that gave them this luxurious lifestyle.
That's interesting. We spoke.
That comes from the IMF itself, somebody who wrote a history of it. That's not me speculating. That's from the horse's mouth.
Great. We spoke a couple of weeks ago, and you told me that despite the fact that I guess gold now has doubled since 2023 from 1900 to 3,800. So that's a devaluation of 50% of the US currency. But you still think that in a crisis, or maybe in a war, I guess, in Europe, you could see the dollar, the fiat dollar, rally really strongly versus the rest of the dollar index components. Could you go into that a little bit?
Sure. The real reason behind that, and the real reason I think is something that's going to happen, is the world as it is right now is actually short dollars, not long. Everybody keeps talking about the end of the dollar, the end of the dollar, the end of the dollar. But the real fact of the matter is that there's $65 trillion outstanding in US denominated debt offshore in the shadow banking system. Now, what is likely to happen if the war starts to directly impact Europe is that money is going to be liquidated when the securities and derivatives that back it are closed down. You will then have to call in the short dollar loan, and you will be forced to buy back. So, you know, that's and when you do that, you'll wind up in a situation where, you know, where the short dollar position, which is enormous out there. Believe me, the demand is for dollars, not against. Not everybody can just simply hold gold. It's not got any velocity to it. So it can't be fungibly wired around the world, although China, as you know, is taking the first steps to try and make that happen. So, you know, you've got this situation where you've got $65 trillion short. You know, foreign holdings of US debt are only $10 trillion. US net worth is 135. So, you know, that money, if you get a situation where the stock market blows out to the downside, or the trades and positions that 65 trillion underwrite, that short dollar position underwrites, get called in, you will simply have to say where the you're long the assets, you're short the dollar, and then they'll have to be reversed. And you'll have to buy the dollars back. And that will create a really vicious run upwards in the dollar. And there is a precedent for this. Actually, at the beginning of World War I, it's not unusual. Except when you look at the precedent this way, remember that at that time, sterling, British pound sterling, was the reserve currency of the world. And the same thing happened. People sold securities to cover their sterling debt. And so when they got the money from the securities, they had to run back and cover the debt in sterling. It's the same thing, except with the dollar now. Then in 1914, it was sterling. And in a few months, you saw dollar sterling move from 468 to 630 in literally 3 months. And then they closed the stock exchange. They suspended gold shipments. We were on a gold standard until that time. And the whole system went into lockdown. And we could be getting towards that type of a situation if things don't change. You know, there's no way we're going into war and all of these markets are just going to stay open and function.
Yeah. And eventually, eventually the sterling actually went downhill all the way to, like, I think it was 1954 actually was when dollar reserves around the world overtook sterling reserves. There's a research by Barry Eichengreen, and he's got the chart. And then, of course, the rate, I think, used to be 487 for like a century, 1 pound. And then now we're at 130. So what I'm trying to say, this blip up and possible squeeze in the dollar would be something temporary, but eventually, you also think that gold will go up with the dollar, right? When that happens?
Absolutely. Absolutely. Gold and the dollar will be the last one standing, the dollar in terms of other currencies. You know, I don't really quite understand, you know, these situations that people keep saying the dollar is finished. Okay, against gold, yes, it's certainly either finished or it's finding its real level, whichever way you want to look at it. But not against the euro, because it peaked in, what was it, about 2008 at 160. And then by 2022, it was at 0.95. So that's not, you know, when you say the dollar is finished, the dollar is finished. Everybody keeps saying finished against what? Okay, maybe against gold, but not against the euro, not against the Japanese yen, where it's been halved in the past couple of years. The only thing other is the Swiss franc.
Yeah. What about the BRICS? Do you think they're trying to move away from the dollar? That's going to have some impact, I guess. I think that's being reflected in the gold price, because a lot of those countries are they're not renewing their dollar investments and they're accumulating gold instead.
Yeah, that's true. And one thing too is that, you know, they want to move out of U.S. debt, or at least U.S. exposure. They want the dollars though, but they don't really want to take on just cash, because you can't really do that. But they're not that enamored with treasuries. They're in a bit of a quandary too, because, you know, there's not going to be any BRICS replacement currency. There's no way, because the renminbi isn't convertible. That's not going to happen. So what they're trying to do is they're trying to create like an almost Chinese Bretton Woods, where they're going to have gold vaults around the world, and they're going to balance trade against the renminbi, and then gold is going to be what you cover the excess with. But the difference being is that the Chinese population has a huge appetite for gold, and the Chinese population, as it stands right now, has $26 trillion worth of savings, which is something no country in the West has. And there's no way they're going back into real estate, because everybody got burned in the real estate market. That leaves only equities and gold. And what's more is the Chinese government encourages their population to buy gold. They don't try and keep it out of their hands. So there's that. And then the biggest performing economy in the world in the past few years, India, has an enormous tradition of buying gold and giving gold during Diwali and as wedding presents. And so what nobody's talking about is that for the people, the middle classes and lower middle classes of India who've been receiving gold as presents for 10, 20 years, they're sitting on an enormous profit. You could see a situation where those gold holdings could be collateralized into purchases of property now within India or around the world for that matter. So there's a lot of demand there, but I still think that yes, the dollar will go up when the monetary system starts to implode further. It's already imploding now. I believe that right now we're looking at a high in the euro.
I see.
At 117.5. If you look at the channel, the downward tracking channel, this is the top. You would have to get through 122, 122.50 consistently.
Yeah. And the dollar index as well seems to be really holding this trend line from 2008 when it bottomed at 70.69, I think it was. Right. And at the time, gold was at 1,031. That was the day Bear Stearns in March 2008 had to be taken over. Gold topped, the dollar bottomed. But despite that, the dollar has gone up and gold has gone up. So like you said.
Which everybody says shouldn't happen.
Yeah. And I don't know if you remember this. I still have it here. But Jim had his golden pillars. And the only one that hadn't really been recognized was this top in U.S. Treasury long bonds. And I think now 2021, I think was the top for bonds. Right now, yields are coming off a little bit. And he always had that target of 1650. And it's interesting because in 2022, when gold spiked lower, it touched like 1600 or something, very close to 1650, and ever since then, gold is
you got the inflection point right. He used to use some very interesting French curve charting techniques.
I remember that, the French curves. Yeah, that's interesting.
Yes, but the thing about it was he also said, because that's only recent. He said, we can't have treasuries and gold going up forever. Sooner or later, one of them is going to break.
Yeah.
And while you have seen treasuries yields start to come down now, and the market come back up, I would caution people, watch the TLT and not what the Fed does.
Yeah. And I've done some ratios, Peter, like gold versus treasury, constant maturity treasury prices, and gold is going up faster than treasury prices are going up. And it's interesting that you use the top in 1980, 887.50. I always remember Jim talking about that because a lot of people say it was 850, but I think Jim knew that the top then. So to wrap up, Peter, could you tell the viewers what is the most important thing for them? I know the viewers have different circumstances financially and professional, but what do you think is the most important fundamental thing they need to know about gold and what's going on?
Well, I think the most fundamental thing is to realize that gold is that the monetary system is now in a total crisis. It's not going to last much longer. Probably, maybe, I don't know, 5 years at the most. That's just me waving a wand and guessing. But eventually, they're going to have to do something about it. On the way, you're going to see a huge rally in gold. And so the point is for people who are just kind of trying to figure out what to do is to commit a part of your assets to gold. If you're not experienced, try not to get involved with the miners. Try not to get involved with junior miners especially, and try not to buy ETFs. Go and pick up some half ounce, quarter ounce, tenth of an ounce coins, and don't go all in. just Jim always said 33%. That could be a lot for a lot of people, but don't be left holding, especially the European listeners, don't be left holding cash forever as your savings without having some type of gold to back it up, quite like a central bank does. Or as Mark Faber always likes to say, it's time to be your own central bank. So a portion of your assets into gold in a physical form that you keep, and that should at least help you sleep better at night and in these crazy times.
Yeah, and again, for the viewers who are looking for a bit more instruction about gold, now you can buy the book again, not for 300 or 500, but for 25. I know it's a PDF, but it's better than nothing. So there you go, a pocketbook of gold. I'm going to put a link to it below in the description. So, Peter, it was really great speaking with you, and maybe we can speak again soon in the future.
Absolutely. You have a good day, Mario.
You too.
All the best.
Thank you.